Hello, I'm Lindsay Hall, Chief Market Strategist for the RMB Group. Welcome to our video series, A Short Course in Futures and Options. In this lesson, we will cover how you're able to insure against the loss of opportunity, as well as the three major factors that determine the price of options. Understanding what happens when you buy an insurance policy is the key to understanding options. Most of us spend a good deal of money insuring the things we care about, our homes, cars, health, and lives. The typical insurance buyer doesn't expect to get into a car accident or have his house burned down. Most of us don't expect to get sick, at least not often. Yet we spend a large portion of our adjusted gross incomes on insurance to protect ourselves just in case. Knowing we're covered frees us to plan for the long term without the fear of unforeseen events. Sure, we complain when we write checks to the insurance company, but for the most part, we're willing to trade this recurring expense for peace of mind. What does this have to do with option investing? Plenty. The three major factors that determine the price of options. First, distance of the strike price from the market price. For out-of-the-money options, the closer the market is to the option's strike price, the more valuable the option will be. Second, time until expiration. The longer an option has to work, the more expensive it will be. A 1-year homeowner's policy costs more than a 6-month policy. Time is money, and option prices reflect this. For example, all things being equal, a September option will always cost more than a June option with the same strike price. Dissipation of time value. The figure here shows the decay in an option's time value over time. Note that the decay is not linear. Time erodes much more quickly in the last few weeks of the option's life than it does in the first few weeks. Volatility is third. The more volatile the market, the more expensive the option will be, because the probability that the option seller will have to meet his obligation rises in direct proportion to volatility. He will demand more money. So the three major factors that determine the price of options. First, distance of the strike price from the market price. Second, time until expiration. And third, volatility. Hurricane insurance will always cost more in Florida than it will in Chicago. Options work the same way. Let's talk now about insuring against the loss of opportunity. An investor can use options to protect against the potential loss of opportunity. Like most of us, you've probably experienced the regret that comes from not capitalizing on a solid investment hunch. Perhaps you didn't buy a stock you had your eye on when it was low because you were afraid it might go lower. You read the paper 3 months later and were devastated to see its price soared. Or you felt interest rates were going to fall dramatically, yet you didn't act and buy bonds in time to capture handsome capital gains. We've all been there. This type of procrastination is common and usually based on a fear of major losses. Here's how to reduce your fear and increase your chances for profit. By using options as a low-cost replacement for cash positions, you can take a position in nearly any major market for far less money than it would cost you to buy or sell the market outright. If you buy options and are wrong, the only thing you lose is the cost of your option premium plus transaction fees. If you're right, you can make almost as much money as if you actually invested a much greater amount in the underlying market itself. The similarity to insurance still holds, only now you're protecting yourself against the loss of opportunity, not the loss of capital. Unlike the holder of a double indemnity life insurance, you want to collect on your policy. Since our premium is all we have at risk when we buy options, we get nearly all the benefits of a diversified investment strategy without exposing a large portion of our portfolio to the market. Knowing a small portion of our capital is doing the work of a much larger amount frees us psychologically and financially, letting us focus on the bigger picture. You have now finished our 6th video in this series. Our next video, an option example, will help you understand the power of using options for trades similar to the crude oil futures contract trade we discussed towards the beginning of the series.